welcome to our August investment update. Today, I'm delighted to be joined by Neil Birrell, who is both Chief Investment Officer for Premier Miton, as well as a lead fund manager of the Premier Miton Diversified Funds. He joined Premier Miton in January 2013 from Elcott Capital, where he was part of the team responsible for managing multi-strategy investments. And previously to that, he was Chief Investment Officer of Framlington Investment Management. Neil, welcome on today's webinar. Thanks for coming.
Not at all. Nice to be here.
Fantastic. So as with all these things, what we tend to do is now ask you to bring your slides up, if that's okay. So when you're ready. Superb, we have them. And as with all these things, what we tend to do is walk through your slides and just have a bit of a general chat. So we're hoping that there's some more, a whiff of optimism, perhaps, coming through on the investment market. And so keen to see what you've got to say on that. Over to you.
Yeah, thank you. And hello, everybody. Yeah, well, we'll run through the slides. In terms of wave of optimism, I think it's fair to say that I've been at the more cautious end of sort of my views on markets than I can remember throughout what's probably sort of through quite a long career, and probably in comparison to most other people as well. And my view has been changing over the course of the last sort of 2 or 3 months. Maybe going on holiday and taking a step back and think about things more broadly helped, rather than being sort of like stuck in the day-to-day of everything that's going on. But I'll just sort of run through it. Yeah, I think there is room for optimism at the moment, even though it might be a case of being darkest before dawn. But let's sort of have a look. I've got a few slides I'm just going to talk through. First of all, I need to talk for a moment or two while the risk slide stays up there, so everyone's got a chance to have a look at it. We're fund managers, and we're not able to give sort of tax or financial planning advice. That's entirely your job, and we're just here to sort of talk about markets and talk about the funds that we run. There's a little bit about me. You've already said that. We don't need a picture of me. You got me on the screen. I've been doing this for quite a long period of time now. In investment markets, all sorts of different asset classes at a number of different organisations, and I think it's fair to say that investment markets have been more challenging over the course of the last sort of 3.5 years than possibly they have been over that entire time. And what we're looking forward to is slightly calmer markets and easier investment decision-making processes. So why don't we have a look at what's sort of going on? I'm just going to put up a few pictures, if that's okay, just sort of describe our thoughts. And I'm going to talk through the economic backdrop and then talk about a little bit about financial markets. I think that's the best way to go about this. And first of all, this is the USA. It's the largest economy in the world. It's their gross domestic product, which is basically the size of an economy. And what we've got there on that chart is the percentage year-on-year change in the US economy, which is the most important one in the world, going back to March sort of 2007. And what you can see there on the left-hand side of the screen is the global financial crisis and the recession that we came through there. Then a period through the 2010s when economic growth was frankly fairly benign, rather than being sort of overly strong. And then you get that extraordinary down and rally in GDP, or the size of the economy, or the economic growth rate through COVID, and then the recovery from that. And I think where we go from here is really sort of quite an interesting sort of point. As you can see on the right hand side there, the economy sort of continues to tick up in terms of growth rates. These are all historic, by the way, and I'll talk a little bit more about the future in a moment or two. And I think what we're going to be seeing is some downgrades to those expectations for GDP, a little bit sort of going forwards. So in other words, not quite as strong as we've been seeing in that upward direction from that chart going forwards. This is the inflation in the US, which everyone is clearly focusing on everywhere in the world at the moment. This is the consumer price index, which is a measure of inflation. Later on, I'll look at another chart which will refer to the retail price index, which a lot of people are more used to, That includes sort of mortgage interest payments. There's always at a slightly higher level, but it goes back further and gives a better example of history. Again, this is the percentage change sort of year on year. And as you can see on the left-hand side there, we start out in 2007, and then we get the global financial crisis again in 2008, 2009. Unsurprisingly, when you get a big recession, you also get a reduction in inflation down to the stage you actually get deflation at that point. And then what we've got on the right-hand side is this huge rise in inflation that we've all experienced everywhere, pretty much everywhere in the world. It was partly driven by, through the 2010s, very low interest rates because economies weren't very strong, as we saw a moment or two ago. And then we went through sort of COVID, when huge amounts of money were pumped into the global financial system by the central banks. That's the Federal Reserve in the US, the Bank of England in the UK, the European Central Bank, the Bank of Japan, all pumped loads of money into the financial system, which was almost definitely going to cause inflation. And it was a case of waiting for that to come through. Then we had all the supply chain issues. You remember back when we were queuing up for petrol, that type of thing. This huge burst of inflation. And then we started seeing inflation coming down again. And it's falling quite sharply in the US, which is really quite important. And part of the reason for this is because interest rates have been going up. And the reason they put interest rates up, it is a very blunt tool to control inflation. And I think it's worth remembering that those central banks, the Bank of England, the Federal Reserve and the European Central Bank all have targets to keep inflation. It's around about 2% their targets, and at the moment, either an average or at a peak. And therefore, that's why rates have gone up to get inflation down. And we're seeing all these problems that we've seen in the world economy. And it also slows economies down. That's the important one. That's what they're trying to do, to reduce price, to slow down economic activity. So that's the US. Very, very similar picture in the UK. This one, more interestingly, goes back to 1955. We've just got the data going much further here. And you can see there, sort of, you get a lot of volatility in the size of economies or gross domestic product, or the growth rate in that gross domestic product. And you can see where it's below the line, that's periods of recession. And you see there's been quite a few of those, going back to the early 70s, then the early 80s, then the early 90s. And then the global financial crisis, and yet again there on the right-hand side, COVID just absolutely stands out. And what's noticeable is where we are, what we've got to now, is that the economic growth or GDP has fallen back down to almost sort of, it's a very, very low level in the UK, skirting with inflation, which is a little bit of a worry, although the data that's coming out has been reasonably good, actually, surprisingly good over the course of the last sort of 2 or 3 months. And in terms of the UK, again, inflation is the important point here. And as you can see, the UK economy typically is slightly more inflationary than the US economy, and slightly more inflationary than the rest of the world. It seems to be a sort of a systematic problem in the UK. And you can see, just to draw attention there, I mean, the spike that we saw in the consumer price index in the UK was extraordinary as we came through that period of rising, sort of rising prices, particularly in fuel and commodities and all that type of thing. It's starting to fall away quite sharply now. It will continue to fall away. This is a year-on-year figure. So as we go through month on month, you'll see previous months of sharp growth falling out, and therefore the actual headline number will start coming down, although there is still an element of it being sort of fairly well embedded in the UK economy. And this is the great concern of the Bank of England. This is why we've seen interest rates go up, and why there is expectation in the interest rates in the UK will probably continue to go up longer than they will in the US, than they will in Europe, than they will in other countries in the rest of the world, to beat that inflation, which does seem to be slightly more embedded in the UK than it is elsewhere. So that's Neil, sort of the backdrop, and I think, yeah.
Neil, sorry, on that point with the inflation here in the UK being sort of more systemic and being sticky, as it's been classified by some people. What are the main drivers behind that? What's the fundamental driver of that? Because my understanding is you've sort of got a domestic inflation issue, really, and then the imported inflation from some of those other things you talked about, energy costs and things like that. Those are dissipating, but we still seem to have this embedded inflation that's really quite stubborn. What's mainly driving that?
That is just a really good question. I mean, it's always been like that. mean, inflation sort of comes through from sort of two angles. One is sort of, sort of demand pull, and one is wage push. And what we get in the UK is sort of quite a lot of the wage push element of it. And I think over the course of the last sort of 2 or 3 years, there's been a huge element of that. I mean, I don't need to run through with the list of strikes we've had in all sorts of different industries. Trying to get sort of inflation-like sort of rate wage increases coming through, and there is evidence that they're starting to come through now. Also, sort of the demand pull side of it's been very strong, and I think the UK has both elements of that more than an awful lot of other economies. The labour markets in the UK are sort of quite tight. It's relatively difficult to manage sort of staff within the UK to manage employment, and therefore I think that is one of the main reasons why it remains sort of stickier than it does in other countries. But like I said at the start, I mean, it is a very good question. It's been like that for pretty much ever, and I think it is that element of the structure of the labour market in this country. The unions are still sort of quite prevalent in it.
So that's something that you've experienced in previous recessions or previous times of economic turmoil where inflation has been high, that actually the UK has always lagged behind other countries for those reasons you mentioned. So tight labour markets, maybe above inflation increases more so in the private sector than you would have seen in the public sector. But also, I still wonder, and I've heard some anecdotal evidence that during COVID and the change in how people worked actually meant that there was a lot more savings floating around in the economy than there otherwise might have been. So some people have been relying on those, but also there's been a change in job practices, working practices. So more working from home, less commuting into work. So there's some cost savings there as well. So it's whether that has actually given people more disposable income, and then maybe the effects of the the sort of the financial crisis last year wasn't really coming home quite as strongly as it was anticipated to, and now we're really only starting to see the interest rates coming into play on people's mortgages this year. So is it all of that that thinks maybe meant that demand has been a bit higher as well as the wage growth, and that's why we've got the problem?
But there's very little doubt. I mean, when you think back to what happened to the savings rate through COVID, and this is why sort of partly inflation has sort of come through as it is. You're right. I mean, the savings rate went flying up through COVID, mainly part for two reasons. One is people can go out, and secondly, people will continue to be paid either through working from home, or the furlough scheme was continued to keep people in sort of well financed. We go through COVID, everyone's going back to work, and you're right, hybrid working conditions these days make everyone's life sort of very, very different. You'll see it as much as I do in terms of the amount of travelling that's taking place. Going into city centres, whether it's by car, whether it's by train, the amount of spending that's taking place within those sort of city centres as a result of that. The saving rate has undoubtedly sort of gone up. The problem that we're seeing now is that the cost of living has jumped up so much, as you can see on the chart there, that people will be spending their savings, and that savings rate will be coming down. Now, that is part of the reason why inflation will be coming down as well. I mean, whilst there is, interest rates are going up, so having more cash on deposit is becoming sort of profitable, the savings will be coming down because of the cost of living is going up by more than that. And so the equation just sort of tips across on the other side.
But it feels like it's going to take a bit longer to play out, doesn't it? Because of that, it's going to take a bit longer for the interest rates to be filtering through on our fixed rate mortgages, and the pain to be really, I guess, felt from more people than what we've seen today.
I think the mortgage rate is the exact point on this one, Mike. When we are just past, aren't we? I think the 2 years from when the stamp duty holiday ended, and I think it was June or July 2021. So anyone who's on a 2-year fixed mortgage will be looking at sort of refinancing now. Anyone who's on a 3-year fixed mortgage will be looking down the barrel of what they'll be doing in sort of 10 or 12 months time. All that's got to roll through. You're seeing sort of the mortgage rates are very, very different from what people were fixing on a couple of years ago. Very, very different, and that can only come through and hurt when they're going to higher fixed rates or into flexible rates. Additionally, the cost of living is sort of considerably higher than it was then. And I think it's worth remembering that when you look at that chart there, this is the percentage change in inflation. just because it's coming down, it doesn't mean prices are falling. They're just going up less fast, and
Yep.
that's still got to, still got to buy it home. Absolutely, yeah.
So is there a view about whether we actually will go into a recession, whether we'll skirt a recession? I mean, they talk about a soft recession or a soft landing versus a hard landing. It feels that it'll be more soft than hard from the data that's coming out at the moment, but is that generally your view?
Economies have remained very robust through all this. I think is probably the best way to describe it. If we just sort of stick to the US for a moment or two, then come back to the UK. I mean, it is the largest, it is the most important economy in the world, and it does look like the Federal Reserve may be able to pull off the trick of putting up interest rates, beating inflation, and keeping economic growth reasonably strong and avoiding recession. If that can take place in Europe, if that can take place in China, if that can take place all around the world, that's probably sort of great news. In the UK, I think the economy is sort of less robust, and economic growth there is not quite as strong in terms of absolute growth at the moment, and inflation is proving a bit stickier. So I think it will be a bit more difficult for the UK to sort of avoid some form of sort of technical recession. It still is at the moment. But I think, and we'll come on to financial markets in a moment or two, but sort of I think so much of that is sort of known already, and whether it be bond markets or stock markets for shares, or whether it be sort of property, if people are trading in property, you sort of look through. These are sort of knowns, we do know that economic growth is going to slow. We do know that inflation is high. We do know that interest rates are going to stay high for a reasonable period of time. But what investors will do will be to look through all that into the future and what's called discount all those sort of factors. So there may well be a recession in the UK. At the moment, it doesn't feel like it's going to be too bad. It looks like the US is probably going to avoid it. It looks like Europe might even avoid it. But it's sort of a case of, even if there is one, sort of, does it really matter for markets? Is sort of the point. And,
so it's interesting, isn't it? The sort of the bad news you mentioned. In isolation, you'd be thinking, oh, that doesn't sound great. But actually, the fact that it's discounted, the fact that the information's out there, the fact that everyone already believes these things will be taking place, means it's priced in to some degree. And I guess that's why there's a potential air of optimism.
Yeah, absolutely. I mean, look, you can look at the International Monetary Fund and various other sort of supranational financial organisations, the World Bank, etc., etc. But they all forecast GDP, gross domestic product size of economies, going forward sort of 4 or 5 years. Now, I can't guarantee anything, but I'll be pretty certain that economic growth forecasts for 2028 that are out there at the moment, there won't be anything like them, what we actually achieve. They'll be a lot higher, a lot lower. Economic forecasting is a very difficult sort of thing to do. But yeah, I mean, these are sort of, people have an idea. I mean, last week, the data was coming out from bodies in the UK. You see the Bank of England are forecasting, all the commercial banks forecast. We speak to an awful lot of investment banks who are putting out forecasts. We see them the whole time. And so much of it is all about whether, what people are, particularly professional investors in particular, is whether they're getting surprised by what's coming out for good or for bad, and that very often affects markets. Now, we do know that economic growth sort of slowed, and in the UK particularly slow a bit more. We do know that inflation is remaining reasonably resilient. We do know that central banks will take different policy measures in terms of interest rates. Governments will do different actions in terms of taxes. We know all these things are going to happen. We don't know quite what impact it's going to have, but it's all this discounting mechanism. It's all people are looking ahead as to what they think these factors will have on financial markets and relevant prices, etc.
Brilliant. Thanks, Neil.
Right. So, blimey, there we go. There's the rest of the world. Look, we've spoken about the US, we've spoken about the UK. Just very briefly, I mean, China, it's worth talking about that just for a moment or two. It is the second largest economy in the world, and therefore it is crucial. They sort of went into their lockdown as a result of COVID a lot later than everybody else, and they're coming out of it now. However, the economy was quite strong. However, it's sort of weakening a little bit at the moment. The property sector in China is the largest part of the economy. So the largest part of the second largest economy in the world is quite important in what's sort of going on. There's one or two issues in the property markets there at the moment, but the government, and it is a controlled economy, and that the government controls everything, that they've got the ability to ease policy or to pump money into the system or to reduce interest rates. So that's going to be supportive. Europe, and it's quite interesting, what you typically get is that sort of countries sort of move through the economic cycle in the same sort of way at the same sort of point in time, either up or down. What we're getting now is a bit of fracturing in that. There are different points in the cycle. The US seems to be sort of further ahead. China is sort of much further behind, and it's just sort of coming out of COVID, so we expect them to be loosening policy. Europe is a little bit behind the US. In that things are looking sort of surprisingly good, actually. Recovery's slower, a slightly gentle pace, but we're probably somewhere near the peak of the interest rate cycle there as well. Japan has come out of nowhere, really. I mean, it's been the lost economy in the world for probably since the 1980s, and they've been trying desperately to stimulate growth. They're beginning to get a little bit of that now. They're beginning to get a little bit of inflation, which is really quite encouraging. We're seeing Japanese companies sort of look externally to get more involved, even thinking about buying companies sort of more internationally through merger and acquisition activity. So you've got different parts of the globe in slightly different positions as well. And we need to factor this in when thinking about how we structure funds and making investment decisions. Emerging markets, these are all countries with less developed sort of financial markets. I mean, China sort of sits there, but I talk about large parts of Asia, Africa, Latin America, Africa, those sort of types of those sort of regions. They've been less economically robust for the last decade or so. However, they are beginning to grow again now. There is more room for optimism, which is quite important, because they are making an awful lot of manufacturing takes place in emerging markets. So that's sort of partly sort of production engine for the world economy, and there's sort of like the signs there of positive news as well. So that's all everything on the economy side. I think it might be worth spending a moment or two, it's okay, on financial markets.
Absolutely.
Given that's where we're investing, and it's all very well talking about economic theory. When it comes around to influencing the prices of the assets we're invested in, that's what we're sort of really caring about. What we've got here is a couple of lines on this chart. It's gilts, which are UK bonds issued by the UK government, and also the base rate in the UK. And I thought it was worth going back a little way with this, just to give a feel of what's sort of going on. So the blue line is the base rate that we also know about. You can see that going back to March 1997, being up at sort of 7 or 8%. The scale for that one's on the right hand side, and then sort of slowly coming down through the 2000s, and then that absolute sort of collapse in 2008 when we went through the global financial crisis, and then staying ultra low through the 2010s when economic growth wasn't very strong. It's worth remembering that putting interest rates up usually has the effect of dampening economic activity, which is and then when you want to stimulate activity or grow economies, you reduce interest rates. When you want to dampen economic activity, put interest rates up. And that's exactly what's happened there. And you'll see there the very low point on the right-hand side, when they're virtually at zero, that's through the COVID phase. What a big jump up we've had, back up to 5% in a very short period of time, to dampen economic activity, which has the effect, or theoretical effect, of reducing inflation. The orange line there is the all gilt index. So it takes all gilts, excluding index-linked ones, issued by the UK government. And that's their movement, and that's their price. And what you can see is they're quite highly correlated, or inversely correlated, to interest rates. If interest rates are low, it makes bonds more attractive, because people think people get a high yield or higher dividend or higher income from them. So when interest rates are low, gilts did very, very well. And then you'll see when interest rates start going up in the UK, gilts start coming down. From the peak to where we sit today, that's round about a 17 or 18% fall, which is a very big fall for what is generally considered to be a very low risk asset. And this has sort of set the scene for investment decision making over the course of the last sort of 2 or 3 years. What we've had is these falling prices in low risk assets or lower risk assets, such as gilts and other bond markets, as interest rates and inflation have been sort of relatively high. And I think what that means from here, certainly our view, is that the same type of thing has happened with bonds issued by companies. The bond market is absolutely massive. There's a huge range of different types of bonds that one can invest in. And we think that these types of where they've fallen to, they're providing returns which I think almost by definition are much more attractive than they were back at the peak, just because the returns are higher. And that's starting to become a reasonably nice base for building a broadly based portfolio. What you would expect to happen is as that blue line starts coming down, as interest rates start coming down, which will be at some point next year. I think they could still, the expectations are they'll carry up in the UK. Then we expect the orange line to start going up again, and the returns on bonds won't just be the yield you're getting or the income you're getting. You should also get some capital appreciation from what you would expect to happen. In terms of stock markets, in terms of valuation, and that's really what we care about rather than sort of absolute level. The chart we've got here is what's called, it's for the FTSE All World Index, so most of the stock markets in the world are included in this, and it's the price earnings ratio, which is effectively a measure of how expensive or how cheap a company, or in this case an index, might be. It takes the price or the value, divides it by the earnings or profits, and the higher the number, the more expensive, given it's a multiple. And you'll see there for each year of this, going back to 2007, the blue band is the range it was in, and the green line is where it ended up going across it. But as you can see, the world stock market, as it stands at the moment, since sort of 2007, so including COVID, including the global financial crisis, including low economic growth, is round about the sort of the average or the median of where it's been. So it doesn't look particularly expensive, but it doesn't look particularly cheap. What drives the share prices up or down will either be rising profits is really good, because that's likely to push share prices up, but equally it means that what you can get is that share price can go up without shares becoming much more expensive in terms of PE. But share prices can go up, and if profits aren't going up or earnings aren't going up, what that means as well is that it's getting more expensive. So they can go up in two different ways. It's much healthier that the PEs, the share price is going up and driven by rising profits than it is a rising sort of PE ratio. But as it stands, the world stock market does not look overly expensive, which is a good starting point in terms of sort of going forwards from where we are. I think it's worth spending a moment just looking at, I talked about the world stock market, okay? It is enormous. It is everything from the very largest US company, which is Apple, the largest company in the world, through to very small companies, whether they be in the US, the UK, or an emerging market. And the way indices work is that the largest companies make up a largest percentage of the index. And what we got here, this is since the end of last year. The dark blue line is the large FANGs or the FANG mass. Everyone talks about these very large companies. So it's Facebook or Meta, as it's known now, Amazon, Netflix, Google, which is now known as Alphabet, Apple, Microsoft, and Nvidia, which is the one that everyone was very excited about in terms of AI back a few weeks ago, and Tesla. They're the largest 8 companies in the US and some of the very, very largest companies in the world. And that's their combined market capitalization, the total market value of those companies' shares. And you can see how much they have gone up this year. It's quite a staggering amount. And then if you look at the grey line there, that is the S&P 500 index, which takes the 500 largest companies in the US, which includes those top 8, obviously, and how much they've gone up. Because those companies are so dominant, they've actually driven the sort of the index, and the blue line is the other 492 companies, and you see how little they've got up. And so what you're getting within stock markets is, and this has happened within the UK, where larger companies have significantly outperformed smaller companies, you get this huge sort of differential in returns within stock markets. So when everyone talks about the market or the stock market or an index, I think it's really important you look within those indices to see what's been going on. Because what's happened to the S&P 500 index, which is the most important index in the US, it represents the US economy of all those companies. There's a huge difference in what's driven those sort of returns. And I think that's sort of worth sort of bringing that out. That's also had an impact because of the size of them on the world stock market overall as well. This is the UK. where the UK has been sort of rather, I suppose the best way, slightly maligned. And a large part of that started back in 2016, and you can sort of see that from this chart here. This is the price earnings ratio. So again, the price, the relative price divided by the profits of the companies. And this particular index shows the FTSE All Share Index relative to the world index. So the higher the number, the more expensive the UK looks relative to the rest of the world, and the nearer the bottom, the lower the number, and the cheaper it looks relative to the rest of the world. And the referendum in 2016 sort of triggered this relative devaluation of the FTSE 100 All Share Index, the UK stock market relative to the rest of the world. Investors have left the UK. They've been worried about sterling. They've been worried about Brexit. They've been worried about the political risk has been fairly significant over that period as well, fairly sort of uncertain. So we're getting to a stage where, again, these big differences you saw in the US within the UK stock market, the US stock market, but also the UK stock market on a historical basis looks really quite cheap to the rest of the world at the moment. So what I'm trying to say here is there are huge opportunities. Everyone talks about the market or markets. I think it's really important you look within them to see what sort of value you can get in those sort of different areas. And the UK sort of really does look quite attractive at the moment. I suppose the next thing you've got to answer is what's going to change all that. Well, I think one thing that might change all that is that what's been driving an awful lot of asset prices is what we call these macro factors. So inflation, interest rates, economic growth, all those types of big economic factors, they drive share prices as well. And you tend to see shares moving in sort of blocks as a result of that. What also drives share prices is the profitability of the individual company, how well that is doing, the sector it sits in, and also the country it sits in. And the UK has been really quite out of favour, and companies within the UK have been out of favour. Within that, small and medium-sized companies even more out of favour. And I think once we start returning to fundamentals driving share prices, and I think that might be coming quite soon, and I think that comes when we get near or past the peak of interest rates, and when we're confident that inflation is sort of on its way down, sort of properly, I think that's when fundamentals might come into effect. And I think that's when the UK might start performing better and be a sort of a core part of portfolios that will drive returns for investors. One other one that's I think really interesting at the moment is property, and these are property company shares. They don't include house builders, so this is commercial property, whether that be office, retail, industrial, all those types of areas. This goes back to 1964. This chart, and a bit like the previous one, what the yellow line there is showing is the valuation or the PE ratio of the property sector relative to the UK stock market. So in other words, the higher the yellow line, the more expensive property looks relative to the rest of the stock market. The lower that line, the cheaper it looks relative to the rest of the stock market. And the blue line there is the retail price index, the one I referred to earlier on, which includes mortgages and that type of thing. But that just goes back further in time than the consumer price index. You see there's a huge, very, very close linkage between the ratio of the property sector, whether it's cheap or expensive relative to the broad stock market. It follows inflation very, very closely. Typically, property does sort of relatively well in periods of sort of high inflation and relatively worse in periods of sort of low inflation. And what we've got here, I think, are two really interesting things. One is that the property sector has only been this cheap. In other words, it's below the zero, the line there. This is the fourth time since 1964 it's been this cheap. It's just ticked back above it, sort of more recent. Also, the relationship between property and inflation is completely broken. And that's partly because everyone was so worried about the UK going into a big recession. They thought that'd be more dominant than the impact of inflation. I think what we'll probably see here is that inflation number will come down, and I think that's certainly the way it's heading at the moment. And I think what we'll see is the relative attractiveness or the relative valuation of the property sector to the broader stock market rise as well, so that relationship will get built. So there's lots of things you can do or look at in terms of markets at the moment to find sort of decent value. And as I go back to sort of the chart a moment ago, which showed that overall world stock market. Doesn't look particularly cheap or particularly expensive relative to history. Bits of the US stock market have gone up an awful long way. Other bits haven't gone up at all and look relatively cheap. It's the same. The UK looks relatively cheap relative to the rest of the world, and bits of the UK look really attractive relative to history as well. So whilst the outlook is sort of difficult, and I think we'll summarise in a moment or two, that's very much the case. There are bits within markets, and I'm just desperately trying to sort of wean myself off in an entire career talking about markets, trying to get away from that, because to me at the moment what's much more important is what's going on within the markets, within the different asset classes. So just to sort of summarise, I'm rather conscious of taking up an awful lot of your time. So where are we? Inflation has gone up to levels not seen for sort of decades. Central banks have had to put up interest rates in order to bring it under control. It certainly seems to be having that effect at the moment. It's possible that we'll see blips of inflationary pressure come through again. That wouldn't be unusual. It doesn't just move in a straight line. I think it looks like recession. Whilst we might go into recession, I think it's not going to be as bad as we previously sort of predicted. I think interest rates are probably as a result of those factors. They might well have peaked in the US. They might well have peaked in Europe now as well. They've probably got further to go in the UK. Maybe one or two more 0.25% increases in order to make sure that inflation is sort of beaten. Financial markets, as I said earlier on, do understand an awful lot of this, do discount an awful lot of this, and do understand an awful lot of this and put it into valuations. So I think for the first time, probably since the first quarter of 2000 and just before COVID, I think I'm getting more optimistic on the outlook in the medium term for just about all asset classes. The short term is still quite difficult because we've got these didn't work our way through rising rates, through rising inflation, through the sort of the peak of inflation. I think if you look to the medium and long term, and by that I mean through 2024 and beyond that, I think there is room to be more optimistic for asset prices. So that's where that is at the bottom there. Reasons to be cheerful, I think they exist.
Brilliant. Neil, that is an absolutely fantastic overview. Really, really do appreciate it. Really engaging presentation. So thank you very much for your time. Everyone, thank you for tuning in to this month's investment update. We will be here again in 3 to 4 weeks' time for another one. Thanks ever so much.